there is a tree in Bombay. In the 1830s, under its branches, a handful of men began to trade paper. No building, no rule book, no regulator. A tree, a crowd, and prices. From that shade grew the oldest stock exchange in Asia, and one of the largest markets on Earth. $5 trillion, 200 million accounts. But that is not the story I want to tell you. Because the interesting thing about India's market is not how large it got. It is that almost nothing in it was designed. Every rule that protects a trader in India today was written in the wreckage of a disaster that came first. The exchange exists because of a crash. The regulator exists because of a fraud. Electronic trading exists because of a fraud. The modern leverage system exists because a different fraud destroyed the old one. This is 151 years of that pattern, repeating. I'm your host, and this is the history of the Indian stock market. India's first securities trading was not in Bombay at all. Brokers were dealing in Calcutta as early as 1830, trading shares of the East India Company itself. Bombay came later. By 1855, around 22 stockbrokers were gathering under banyan trees in front of the town hall, in the area we now call Horniman Circle. Shares in banks, in cotton presses, in shipping companies. No membership, no clearing, no settlement guarantee. A trade was a handshake and a reputation. Hold on to that, because it matters more than anything else in this episode. Almost every crisis in Indian market history, for the next 170 years, comes back to the same root problem. Somebody was allowed to trade something they could not actually deliver or pay for. The first great Indian mania was imported from a war on the other side of the world. In April 1861, the American Civil War began. The Union blockaded southern ports, and Britain's cotton mills, the engine of the largest economy on Earth, were cut off from their supply. Britain turned to India, and Bombay, sitting at the export end of the country's cotton belt, received one of the great trade windfalls of the 19th century. Money poured in faster than anyone could spend it, and it went where surplus money always goes. The number of joint stock companies trading in Bombay grew from about 10 in 1855 to more than 100 by 1864. Banks, land companies, shipping lines, insurers. The promoters could not print prospectuses fast enough. At the center of it stood a man named Prem Chand Roychand, a broker since 1849, later a founding member of the exchange itself. In 1864, he promoted the Back Bay Reclamation Company to reclaim land from the sea along Bombay's western foreshore. At the same time, he sat as a director of the Bank of Bombay, while that bank became one of the principal sources of credit for the speculation. Now listen to the numbers. Back Bay Reclamation shares had a face value of 5,000 rupees. In the frenzy, they changed hands for as much as 50,000. Bank of Bombay shares, face value 500, traded up to 2,850. Clerks, lawyers, editors, servants. They crowded the streets trying to get their hands on any share at all. And the mechanism underneath should look extremely familiar. A bank would lend against the shares of a finance company. That finance company's promoters would float a reclamation company. And then, both the bank and the finance company would lend against the reclamation company's shares. Each layer of credit was creating the collateral for the next layer of credit. In April 1865, the American Civil War ended. By the 1st of May, Britain could buy American cotton again. Indian cotton collapsed, and with it, the entire structure of borrowed money resting on top of it. Back Bay shares fell from 50,000 rupees to under 2,000. More than 96%. Bank of Bombay fell from 2,850 to 87. When hundreds of forward contracts came due that July, the speculators could not settle. Bombay's merchant class was destroyed in a single season. Roychand lost most of his fortune and spent much of the rest of his life as a philanthropist. If you have seen the Rajabai Clock Tower at the University of Mumbai, he paid for it and named it after his mother. Every element of 2008 was present in Bombay in 1865. An external demand shock, a property vehicle, bank credit lent against its own inflated collateral, and a settlement system that only worked while prices were rising. The instruments change. The plumbing failure does not. Order came out of the wreckage, as it usually does. The brokers moved to a permanent home on a street named for the Gujarati and Hindi word for broker, Dalal Street. And on the 9th of July, 1875, they formalized themselves as the Native Share and Stockbrokers Association, the first stock exchange in Asia. And then, for a very long time, almost nothing happened. For most of the 4 decades after independence in 1947, India ran a planned economy. Industrial licensing controlled who could produce what. Foreign investment was restricted. A government official frequently decided the price at which a company could sell its own shares to the public. The market was small, illiquid, and closed. Settlement was fortnightly. Trading happened in a physical, open outcry ring. And the funding mechanism underneath it was something called badla, a carry-forward system that let a trader roll an unsettled position into the next settlement period for a fee. In practice, leverage priced by demand, with no central counterparty standing behind any of it. Badla is the thread running through nearly every crisis in this episode. In April 1982, that system met a man who understood it better than it understood itself. Reliance was then principally a polyester business and unusually dependent on retail shareholders. Dhirubhai Ambani had done something no Indian promoter had done at that scale. He sold shares directly to ordinary savers in small towns and treated them as a constituency. A bear cartel, generally identified as being led by a Calcutta operator called Manu Manek, known as the Black Cobra, short-sold roughly 1.1 million Reliance shares. The plan was conventional: hammer the price, panic the retail base, buy back cheaply. The stock slipped from about 131 rupees down to 121, and then it stopped falling. Buyers sympathetic to Reliance absorbed everything the bears sold, every share. Settlement day was Friday the 30th of April, and the cartel had sold shares it did not own and could not deliver. Under normal badla rules, they would have paid a modest fee to roll forward. This time, the buyers demanded delivery and quoted a carry-forward charge so punitive that rolling was pointless. There was no mechanism to resolve it, no clearing corporation, no margining worth the name. So the exchange closed. For 3 trading days, India's stock market went silent, while the authorities tried to broker a settlement between 2 groups of men who could not agree on who owed what. The lesson traders usually take from that is never short a stock with a determined promoter and a loyal retail base. That is the small lesson. The large one is that the structure was the risk, not the analysis, not the direction, the plumbing. On the 1st of January, 1986, the Bombay Stock Exchange launched the Sensex. 30 shares, base value 100. Suddenly, the market had a scoreboard, a single number, printed daily, that turned a professional activity into a national conversation. Then, in July 1991, everything changed at once. Facing a balance of payments crisis, with reserves down to a few weeks of imports, and the country pledging gold to raise emergency finance, the government of Narasimha Rao and Finance Minister Manmohan Singh dismantled the entire apparatus. Licensing gone, Tariffs cut. The rupee devalued. Foreign investment welcomed. An economy held underwater for 40 years came up for air, and the market repriced for a future nobody had previously been allowed to imagine. Into that euphoria walked Harshad Mehta, a broker with a genuine feel for markets and a much rarer talent for finding the gaps between systems. His public argument was that Indian equities had been suppressed by decades of control and were about to be revalued upward. A great deal of that was defensible. How he funded the trade was not. Between 1990 and 1992, Mehta exploited the interbank ready-forward market, where banks lent each other money against government securities. The system ran on bank receipts, documents acknowledging securities that were supposed to exist. Mehta obtained fraudulent bank receipts. The banks were effectively lending against nothing, and he channeled that money into a concentrated basket of Bombay stocks. The market did what a market always does when someone applies effectively unlimited borrowed money to a limited float. The Sensex climbed from around 800 to past 4,000 by March 1992, peaking at 4,467 on the 22nd of April. Mehta became a national celebrity, the big bull of Dalal Street, the sea-facing penthouse, the imported cars. He was, for a moment, what the new India was supposed to look like. Now here is the part that should frighten you. From the outside, his rally was indistinguishable from a real one. The companies were real companies. The story was coherent. The financial press agreed with him. Every test a retail investor could apply, that rally passed. The one thing that would have exposed him was a question nobody was asking. Where is the money coming from? A journalist named Sucheta Dalal asked it, in print, in the Times of India, on the 23rd of April, 1992. The structure collapsed within weeks. The Sensex lost more than half its value from the peak. Banks discovered they held receipts for securities that did not exist. Mehta was arrested, faced dozens of criminal cases, and died in custody in 2001, with most of them unresolved. But the scam's real legacy is not the story. It is the infrastructure. Practically every feature of the modern Indian market was built in the 4 years after Harshad Mehta. The Securities and Exchange Board of India had existed since 1988 as an advisory body with no real power. The SEBI Act of 1992 gave it statutory authority to investigate, to penalize, and to make regulations. The National Stock Exchange was incorporated that same year. Institution-owned, deliberately designed to be immune to the broker club governance that ran the old exchange. It began operations in 1994 as India's first fully electronic, nationwide market. And competition did what regulation alone would never have achieved. The Bombay Exchange went electronic in 1995. The Nifty 50 launched in 1996, and physical share certificates, pieces of paper that could be forged, or lost, or stolen in transit, began to be replaced by electronic holdings. Within a decade, India went from open outcry, fortnightly settlement and paper certificates, to a fully electronic market. Very few countries anywhere have moved that far, that fast. It happened because a scandal made the status quo indefensible. 9 years later, it happened again. Same shape, different props. Ketan Parekh was a chartered accountant from a broking family, and he rode the technology mania of 1999 and 2000. His basket became known as the K10, small, illiquid technology and media stocks in which a determined buyer could move the price. He funded those positions by borrowing against the very shares he had already inflated, notably from a cooperative bank of which he was himself a director, plus badla, plus circular trading through networks of satellite brokers. Then the dot-com bubble burst and the pyramid unwound in reverse. Parekh could not meet his badla payments. Around 70 Calcutta brokers defaulted. Banks discovered the collateral behind their loans was worth a fraction of the loan. The Sensex, above 6,000 in early 2000, fell below 3,800 by the end of March 2001. SEBI's response was structural rather than merely punitive. It banned badla outright. All deferral products gone. Short selling suspended. Margining tightened. And in its place came properly regulated derivatives. Index futures from 2000, index options from 2001, cleared through a central counterparty with daily margining. India replaced an informal leverage system that had existed since the 19th century with a formal one. Hold that thought, because we come back to it, and it matters more than anything else in this episode. A market's character shows in what frightens it, and India's list is unusually political. Two of its worst single days in modern history were election days. On the 4th of June, 2024, exit polls had pointed to a landslide, and both benchmarks closed at record highs. The following morning, the actual count told a different story, and the Sensex fell more than 6,200 points intraday. Nothing about the country's economy had changed in 24 hours. What changed was the gap between what was priced in and what was true. But the big one came earlier. From 2003 to 2007, capital flooded in, and the index multiplied sevenfold, reaching 20,873. And then in 12 months, it gave back 3 years of gains. 8,160. A drawdown of 61%. The worst in the market's modern history. Now, what follows is the part nobody makes a film about. 6 years. That is how long it took to get back to even. 6 years of grinding, of false starts, of new highs that were only new relative to the last disappointment. Every long-term return figure you have ever seen quoted contains a stretch like that inside it. On a chart, it looks like a dip. Lived through, it is most of a decade of your trading life. The third great Indian market scandal was not a broker cornering stocks. It was about microseconds. The National Stock Exchange offered something called co-location. Brokers and proprietary trading firms could place their servers physically inside the exchange's premises for faster access. The allegation, investigated by SEBI and then by the Central Bureau of Investigation from May 2018, was that some participants received preferential access to the exchange's data feed. Connecting first to a less crowded server and receiving price updates fractionally ahead of everybody else. And then the case took a turn nobody could have scripted. A CB order in February 2022 found that Chitra Ramkrishna, the exchange's former managing director and the first woman to run an Indian exchange, had for years been sharing confidential information by email with an unidentified figure she described as a spiritual guru dwelling in the Himalayas. According to the order, that same person influenced a senior appointment inside the exchange. SEBI fined her 3 crore rupees and 2 crore each on the exchange and 2 other officials. She was arrested in March 2022. The yogi has never been identified. The salacious detail buried the substantive one. India's largest exchange, which is itself a first-level regulator of its own members, had governance weak enough that its leadership could be steered by an outside party for 2 decades. Then came the change that actually redefined this market. March 2020, the fastest crash in the market's history. 13.15% in a single session, the worst day on record. But that crash coincided with something else. Cheap smartphones, near universal digital identity, instant onboarding, a generation of zero brokerage, app-based platforms. What followed was the fastest expansion of retail market participation anywhere ever. Demat accounts crossed 200 million in mid-2025 and reached roughly 225 million by the end of the 2025 to 26 financial year, more than tripling in 4 years. But the number that matters most is the systematic investment plan. Automatic monthly investing. Those accounts reached 104.5 million, with monthly contributions running above 30,000 crore rupees. That flow is automatic, monthly, and largely indifferent to headlines. March 2026 was the test. The Nifty 50 fell 9.37%, its worst month since March 2020, and foreign investors sold a record amount of Indian equity in a single month. And that same month, retail contributions rose to an all-time high. Over the full financial year, domestic institutions put in a record 8.5 lakh crore rupees against foreign outflows of 1.8 lakh crore. The domestic share of Indian equities hit an all-time high. Foreign ownership fell to a 15-year low. For its entire modern history, India's market rose and fell on foreign money. It no longer does. That is the biggest structural change since 1992, and the only one that happened without a scandal to force it. On the 1st of December, 2025, the Sensex reached 86,159. From 100 in 1979 to 86,000. A compound annual price return of roughly 15% for 46 years, before dividends. It is the most impressive number in this episode. It is also the most misleading, because it was only ever available to somebody still holding after 1992, after 2001, after 2008, after 2020, and after 2024. Every one of those years handed you a rational, intelligent, well-argued reason to get out. And there is a second number that almost nobody puts next to it. Remember when India replaced badla with regulated derivatives? That decision built the largest index options market on Earth. Contracts traded on Indian exchanges have run at more than 4 times the next closest market in the world. That is usually presented as an achievement. The regulator's own research says otherwise. Across the 3 financial years to March 2024, individual traders in the futures and options segment lost a net 1.81 lakh crore rupees, roughly $21 billion. Only 7.2% of them finished those 3 years in profit. In the following financial year, after SEBI curbed weekly expiries and raised contract sizes, around 91% still lost money, and aggregate net losses widened by 41%. 43% of those traders were under 30, and the counterparties booking the profit were proprietary desks and foreign investors, with almost all of those profits coming from algorithmic trading. So sit with this. The same market, in the same country, in the same decade, produced roughly 15% a year for people who bought and held, and a 91% loss rate for individuals trading its derivatives. Same index, same economy, opposite outcomes. The difference was not intelligence, it was not information, it was instrument, leverage, and time horizon. So what does 151 years of this actually teach a trader? 4 things. First, compounding is real, and it is only ever available to survivors. The arithmetic is genuine, but it is paid out exclusively to people who were still in the seat afterwards. Second, ask where the money is coming from. Meta's rally and Parex's rally both looked identical to a genuine bull market on a price chart. The tell in both cases was funding, not price. When something is rising, and the only explanation on offer is that it is rising, the question is not, why is this going up? It is who is buying, and with whose money. Third, structure kills more accounts than analysis does. 1865 was a settlement failure. 1982 was a settlement failure. 2001 was a settlement failure. India's entire regulatory architecture exists because people were repeatedly allowed to take positions they could not fund. The retail version of that is leverage you cannot survive, and it ends the same way at every scale. And fourth, know which side of the statistic you are standing on, 15% or 91%. Same market. That is a choice about method, not a prediction about direction. From a tree in Bombay to $5 trillion, the constants have not moved an inch. Greed, fear, and the discipline that separates the survivors from the statistics. Thank you for listening.